It's a new month here at Henssler Financial, and we found 3 important things to focus on in the market this month. Number 1, inflation. We know you're likely tired of hearing about it, but inflation will continue to be one of the most watched data points for months to come as the U.S. and the globe continue to grapple with multi-decades high inflation. August CPI came in a bit below expectations at 8.5% compared to expectations for 8.7% and instantly drove down the implied probability of a 75 basis point hike by the Fed come September. Now, there's still more than a month and plenty of additional data that will come out before the Fed's 2-day policy meeting, so expect this to change. Nonetheless, as was the market consensus, it seems as though inflation has peaked for now, barring some sort of unforeseen event. Number 2, the yield curve. One of, if not the most followed recession indicators, continues to flash warning signs, further driving concerns of an impending recession for those seeking signs beyond the last 2 quarters of negative GDP growth. The yield curve, which illustrates interest rates of U.S. government bonds across various maturities, continues to deepen its inversion to levels not seen since the bursting of the tech bubble in 2000. Typically, bond investors expect to be paid more for locking up their money for a long stretch, so interest rates on short-term bonds during, quote, normal times are lower than those on longer-term ones. Currently, however, this relationship is inverted, with the yield on short maturities exceeding those of longer-dated bonds. The 2 most talked about maturity differentials for comparison are the 2-year minus the 10-year and the 3-month minus the 10-year. Currently, the 2s minus 10s, as it's known, is inverted 49 basis points, meaning that a 2-year bond offers a yield that is 0.49% higher than a 10-year bond. While not inverted currently, the 3-month minus 10-year turned briefly negative on August 1st, a sign of the market jitters sparked by tensions over Taiwan. Last time the yield curve by this measure was inverted was March in 2020 during the depth of the pandemic market panic. Number 3, geopolitical tensions. There's one thing that the market doesn't like, it's uncertainty. And in a series of several years in which unforeseen events have become the norm, think COVID and the war between Russia and Ukraine, investors have started to get spooked at the potential of another such event as tensions between China and Taiwan are heating up. China has held its biggest ever show of military force in the air and seas around Taiwan following a visit to the island by U.S. Speaker of the House Nancy Pelosi. China sees Taiwan as a breakaway province that will eventually be under Beijing's control again. Taiwan, on the other hand, sees itself as distinct from the mainland with its own constitution and democratically elected leaders. China's President Xi Jinping has said reunification with Taiwan must be fulfilled and has not ruled out the possible use of force to achieve this. U.S. intelligence officials insist that China will not invade Taiwan in the near term. However, as investors, we must consider what the implications might be should such an event occur. In the event of a military conflict, China's manufacturing sector is deeply linked with nearly every other global economy, including the United States and Europe. Furthermore, the seas around China and Taiwan are some of the busiest shipping lanes in the world, so any disruption would have a significant economic impact. And that's been your Market Minute for the month of August. Thanks for listening.